So hi everyone, it's Jordan right back here, and in this lesson we are going to be covering chart patterns. So these are the major forex trading chart patterns you must know before trading, right? So before we go any further, I want to define something about patterns. So a pattern is bounded to at least two trend lines, either straight or curved. Okay. So patterns have a combination of entry and exit points, like the point at which you enter the trade and the point at which you exit. Okay. So patterns can be continuation patterns or they can be reversal patterns. So a continuation pattern is whereby you are in, for example, a clear trend, and then after getting this pattern, you continue within that trend. And then a reversal pattern is whereby you are in a trend, okay, and after getting this pattern, of course, that trend changes direction. Okay. So patterns are fractal, meaning that they can be seen in any charting period. For example, in a weekly, daily, minute, or hourly time frame. So it doesn't matter for the time. You can find a double top in the weekly chart, and you can also find a double chart in a minute chart. That's what it means. So pattern is not complete or activated until the actual breakout occurs. So, for example, if you are in a clear uptrend like this, then you get a pattern like this. So this pattern, for it to be completed, it has to be broken first. Okay, it has to be broken from around this area. So for a pattern to be known as a pattern, it is supposed to be complete, or it is only activated when a breakout occurs. Okay. So there are some limits to patterns, and I want you to keep in mind that some human tendencies can be dangerous for investors. For example, they see patterns where there aren't any. Okay, they believe in market law or like technical and fundamental without evidence. They look backward rather than forward. So, for example, you're in a trend like this. Then right here you get a pattern. So instead of looking to where the price is going, people normally check where the price has been coming from. Okay, so you have to figure out where the price is going, because that is what you need. And then stick with the original price of patterns after conditions have changed. Okay, so for example, when you get a pattern, then you get a pattern here, the person, and then the price changes. For example, you expected a continuation, then the price moves backwards in a different direction. So people tend to keep their orders, expecting the price to keep going higher. It won't happen. Okay. So when the market changes, you also have to be flexible and change, irrespective of the fact that you got a pattern that has been in your charts very well and it has worked for you. Okay. So so the techniques of trading patterns. So some chart patterns provide continuation signals, and where price continues in the direction of the trend. For example, the peanuts, rising wedge, falling wedges, and these ones are so-called continuation chart patterns. So for example, if you're in a clear downtrend, okay, and then maybe right here you get a pattern for a continuation pattern, of course the trend will continue downward. Okay. And then some charts provide reversal signals where the price changes direction from the major trend. For example, we have the head and shoulder, the inverted head and shoulder. We have the double top, the triple top, triple bottom, ascending triangle, descending triangle, rounded top or rounded bottom. So we shall cover all those ones. For example, if you're in a clear uptrend like this, and then right here you get a head and shoulder pattern, we expect a reversal into a downtrend from the recent uptrend. Okay. So based on the direction of the ability of the patterns to indicate a potential price direction, the following can be classified as bullish patterns. So some patterns are bullish patterns. This is where that your bullish patterns whereby you may be in a downtrend, and then you get a pattern, and then the price changes into a bullish momentum. And then if you are in a downtrend, okay, and the price changes, that one becomes a bullish pattern. So if you're in a clear uptrend and then the price changes, that once the pattern you got before the price changed to a bearish downtrend is what we call a bearish pattern. Okay, so here we have examples of bullish patterns. We have the ascending triangle with the rounded bottom. We have the peanuts, wedges, cup and handle. We have the double bottom. We have the triple bottom, inverted head and shoulders. Okay, those are all bullish patterns, meaning that every time they form, the price will change into a bullish momentum. And then here we have example of bearish patterns. We have the descending triangle. We have the rounded top. We have the double top. We have the triple top. We have the head and shoulder. So for example, you're saying if we're in a clear uptrend and then here we get a triple top, we expect a reversal into a downtrend. So that is what classifies the triple top as a bearish pattern. Okay. So we are going to be starting off with the head and shoulder pattern right here. So what's the head and shoulder pattern? So the head and shoulder pattern is normally made up of left shoulder. We have the head, okay? Then we have the right shoulder. It is in this format. They said we have a shoulder first, then we have a head, then this is the head, and then we have another shoulder. Okay, that's how the pattern is. For example, the price has been coming from clear, forming a clear uptrend, and then you get this left shoulder, you get the head, and then finally you form this right shoulder. So this is what it confirms it as a head and shoulder. But it is only supposed to be confirmed as a head and shoulder if this level is broken downwards, like this. If price comes and breaks this level, okay, that is what they call the neckline. That level is called the neckline. So if it is broken, the neckline is broken, it becomes a head and shoulder. But if the neckline is not broken, for example, price goes up, 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 forms first a left shoulder, then a head, then the right shoulder. Then after forming that pattern, it does not break it and then it continues upwards. This is no longer head and shoulder. Okay, it is no longer head and shoulder because maybe you predicted it poorly, or sometimes it is a perfect head and shoulder, but the price does not follow the pattern it is supposed to reverse to. Okay, so I want you to note that head and shoulder is made up of left shoulder, is made up of the head, is made of the right shoulder. So it has these 2 points, these 2 levels of support. They act as the neckline. Okay, so let's look at it into more details. So this is the neckline. Okay, and then we expect a reversal into a downtrend. So this one happens in a clear uptrend. Let us look at the head and shoulder. We are looking at the head and shoulder pattern. So this is a bearish reversal pattern. It means that when it happens, we get a change into a bearish trend or a downtrend. Okay, so this pattern provides an entry point and a stop loss point maybe, and take profit is calculated a multiply of the stop loss. We shall look at that one later. So it is distinctive. Left shoulder identifies the pattern and the head followed by the right shoulder. Okay, it is made up of the left shoulder, made up of the head, and then the right shoulder. Okay, and then the neckline is another critical component of the head and shoulder pattern, and the neckline is drawn by connecting the base of the shoulders and the head. Okay, so we are saying, okay, so the pattern is completed once the left shoulder, head, and right shoulder are formed, followed by the neckline break. If the neckline break is not broken, please do not trade this pattern. So the neckline break by the price is considered the best entry point. Okay, so the stop loss can be placed on the high of the right shoulder, while the take profit can be calculated at a 1 to 2 reward risk. But we talked about take profits, and we cannot use this format. We shall be using the ATR, or the average true range indicator. Okay, so we are saying you have a head and shoulder. For example, this one here. Okay, it is formed like this. You have a clear uptrend. Okay, you have a clear uptrend. So at this uptrend here, you form a upper shoulder. So it's the left shoulder. Then you form a neck. Then you form this other shoulder. And then after the price breaks that level, that is when we are going to be allowed to trade. Okay, so the neckline is when you join the base of this shoulder right here, and then this one is points. Okay, here. Hold on a bit. So this is going to be a neckline right there. That's a neckline. Okay, so when the price comes and breaks this neckline, so the pattern becomes confirmed. When the price breaks these levels, it becomes confirmed. And when it is confirmed, we only take a trade after the neckline break, and then we say that the stop loss can be placed above this right shoulder. Okay, and then if this is 20 pips, we can calculate 40 pips as a reward. But there is a better way of taking profits in Forex that has been invented. Okay, so here we can take profits. If you're risking 20 pips to get 40 pips, or $20 to get $40, something like that. Okay, so when you look at the pattern here, you have a clear uptrend. That's the first thing you have to identify. If there is no clear uptrend, please do not look for head and shoulder pattern. And then after forming this left shoulder, you will form a neck, then you form a right shoulder, and then this one is confirmed after the neckline break. And after the neckline break, that's when you press your sell stop order, and then you target the swing low of the trend, or you target a given take profit that will be discussed in strategies more. Okay. So the other thing I want you to note about the head and shoulder pattern is that it will not be perfect like you're seeing it on the screen. So today in this image here, it is looking perfect. You're seeing this. This is a head and shoulder, but I want you to note that after seeing something like this is going to also be head and shoulder. Even if it looks like it is falling, it will still remain head and shoulder. Or you might get something like this, and this neckline is going to be drawn sloping upwards, or sometimes you'll see that the neckline is drawn sloping downwards, or sometimes it will be a vertical line. Okay, so cool, so perfect. Do not force things. We shall be looking at it when we go into a live chart. Okay, so that's that head and shoulder pattern. The key points to note about the head and shoulder patterns is this neckline. After the neckline break, that is when you take your sell order, and it occurs on an uptrend, and after it has occurred, we expect a downtrend. Okay, so the head and shoulder is only confirmed when it forms this shoulder, it forms the head, and then it forms another shoulder, and then the stop loss is placed here. The entry point is after the neckline break. Okay, and then followed by a new downtrend. And we said that the neckline can be in this format, can be a straight line, or it can be a falling line. Okay, it can be like a simple trend line. Somebody can be connected like this, something like that. Or sometimes you'll find in places where you're going to connect it and it is a little bit falling. In other times it will be found straight. Okay, that's the head and shoulder. We move on to the next pattern. So we shall be going to a live chart later on after completing all the patterns. Then we'll be able to spot some patterns on a live chart compared to these images. So we have the inverted head and shoulder, and this is the opposite of head and shoulder pattern. So the inverted head and shoulder, okay, this one occurs in a downtrend like this. The other one was occurring in an uptrend. So after that, you form a right shoulder, then you form the neck, then you form left shoulder, then the price will start a new uptrend. So it becomes a neckline, and that's the entry point. So when you look here, this was a clear downtrend. You form the left shoulder, you form the head, then you form the right shoulder. So for example, like I said previously, the neckline will always not be a straight line. So when you look here, this is a slope. This is a short trend line. Okay, a short trend line connecting these 3 points. Okay, so when you look there, that's a neckline, and when it is broken from right here, this could have been an entry point, and then the stop loss would be around here, and then you target the profits up. Okay, so this is the inverted head and shoulder. Okay, so that is how it looks. This one also looks like the line was sloping a little higher, but sometimes you can find it when the neckline is so clear like this. So this is the left shoulder, this is the head, this is the other shoulder. So after the neckline break, you will get a new uptrend. So it occurs on a downtrend, and it is a bearish reversal pattern. Sorry, a bullish reversal pattern. So this is a bullish reversal pattern, and the pattern has similar components like the head and shoulder. So here it is the opposite. Okay. So we are going to onto the next one, and that is the double top. This is our other chart pattern. So the double top occurs in an uptrend. That's why it is called top. Okay. For a clear uptrend, you get that something like that. This is what we call the double top. So for example, in look here, this was a clear uptrend. We formed the first top, then the price trade retrace again, and then it forms a new uptrend. Okay, and then it finally breaks after forming this double top. Okay, so double top, it means that here it forms a neckline. So for example, you have a clear uptrend. Okay, so price hits a level of resistance, drops, it goes back again, hits this level of resistance once again, and then it drops. But when it drops, it breaks this level of support that it created previously. So that confirms the double top. So in most cases, it will come back and retest this level of level of support to become a resistance, and then finally you will get a drop. Okay, I'll make it clear once again, repeating it for you. So for example, you are in a clear uptrend, something like this. So the price hits a level of resistance, it drops, okay, to a certain level. It goes back, hits that same level of resistance, and then it drops. But this time when it drops furthermore, a little bit, and then it tries to come back to retest this level, and then it drops, okay, to create a new downtrend. So what has happened in the market? So what has happened is that the price was in a clear uptrend. That is number one, you have to note. It found a level of resistance 2 times. That is number two. And then the recent swing low here was broken by the new swing low that was supposed to be created. So this confirms a double top. Okay, but in most cases you can say this level is not broken, and then the price goes back, hits it, and then it now comes back downwards. This now is going to become a triple top. Okay, we shall see it later. So after the price has broken this level here, this becomes our neckline. So in most cases, most of the time, the price will look at this level of support. This is a previous, because price goes high, resistance forms a support level. Goes high, resistance comes to meet the support level, but it breaks the support level at that time. After breaking it, it will tend to come back and retest that level, and then it will drop downwards. I want you to note that. For example, when you look at the chart here, the price went, forms that level of resistance first, goes resistance once again, and then it breaks this level of support at first, and then after that it tends to what, to retest that level, and then it then sells off. As simple as that. That is the double top. It occurs in an uptrend. I want you to note that also. So we are still talking about the double top. As you've seen here, this is a clear uptrend, and then it forms the first peak. This is a level of resistance 1, level of resistance 2, and this is a support level. So we are expecting the price to hit this support level and then bounce off. But what happens? It does not do what? It does not test the support, but it just breaks the support. Here it tried to bounce off, but it failed, and then it broke to form a downtrend. So in most cases, it is coming back, I said retest, and then it will move backwards once again. Okay. So we are saying this is a bearish reversal pattern because the preceding trend is a bear trend. That's why we call it a bearish pattern. Okay. And the price makes swing highs, say swing low A, then retraces to move once again and then forms top B, but first to create a new swing high higher than the previous swing high. Okay. So the price's failure to make a higher high makes the price fall back to the neckline, and the neckline is the horizontal line connecting the base of the lowest point of retracement point that was formed by point A, okay, and top B. So the formation of both top A and B and then the break below the neckline completes the pattern. So a clear break of the neckline provides a best entry point and indicates the current trend's reversal. So the stops are placed above the previous swing high, and then profits can be booked as a reward of double the risk. Okay, so we are saying that after the price forms the swing high, it comes down. Here, this is the first level of resistance. Here, it forms a level of support. So it goes high once again, but it comes to meet this level of support and bounce off, and it fails. After it has failed and then it breaks that level of support, that confirms at double top. If it has not broken this level of support previously, maybe say it goes high again, that is no longer a double top. That is what you have to do. And we said that a pattern is only formed when it is broken. Okay, so breaking of it provides for us with the entry point. For example, this was the entry candle, and then the stop loss is in most cases placed above, or it can be placed at 1.5 of the ATR, like we've seen with the ATR indicator. Okay, so that's a double top. We shall see it in the live chart later. Okay, so that's how a double top looks on a line chart. Sorry, this is a double bottom. Okay, so for a double bottom, it is the opposite of a double top. So here you have bottom A, and you have bottom B, and then you have this level of resistance at the neckline. After it is broken, in most cases, you will see this retest, and then the price will reverse to form a new uptrend. Okay. So the double bottom is a bullish reversal pattern. The other one was a bearish reversal pattern. The opposite of the double top bottom. The confirmation of the pattern is as after the break of the neckline, after formation of the double bottom, of the double bottom points A and B, then stops can be placed as swing high of the bottom B, and profits can be booked at double the risk. So double top and double bottom patterns are generally referred to as M, some literature, and then W, whereby M is double top, then W is double bottom. Okay, and these patterns. Okay, so we are saying that this double top pattern is sometimes it's known as M, and then the double top is known as M sometimes, then double bottom sometimes known as W. And then this double top occurs in an uptrend, double bottom occurs in downtrend. So you get your first bottom, you get your second bottom. This level of resistance that was created after a bounce of this point A is what confirms our neckline. And when it is broken, I told you in most cases the price will come to retest it and then it will form a new uptrend. So the entry point can be after immediately breaking the neckline, or you can wait for this retest. Okay, if you are a chicken in the market or you're new to trading, you don't want so much of losses. Okay, so we continue. We are going on to what we call the triple top. So the triple top looks like this. This is just over similar to the double top, just it extends to more from a new peak. Okay, so you get a resistance tested twice, and we are expecting it to be tested a third time, but what happens is that it is now broken, and then we expect a retest, and then we form a new trend downwards. That's what we call the triple top. So we normally put the stop loss at the swing highs, and this is our entry, and then take profit can be at 2 times the risk, or sometimes we use the ATR indicator. So that is how the triple top looks like in a live chart. In most cases, top A, top B, top C. And as we said before, necklines can be in this format. They cannot be straight lines all the time. So here, after the break of the neckline, you got this short, but in most cases, for example, here it was not so much of success. So triple tops are rare and an extension of a double top pattern, and it is a bearish reversal pattern. So the formation of 3 consecutive tops and the price break below the neckline confirms the pattern completion. So we say that if the pattern does not break this, for example, it reverted from here, this is no longer a triple top. Okay, it's only confirmed after breaking that level of support that was formed previously. And the entry point is upon the neckline break, and the risk is calculated towards the swing high C, and profits can be booked at 1 to 2 risk. So though we are changing this, level on this literature we are providing right now in this video. Okay, so that's the triple top. It is just an extension of the double top. So our another pattern is the triple bottom, and this is the opposite of the triple top. So triple bottom, we have 3 successive hits of level of support. Okay, and then we are after breaking this previous level of resistance, we expect a retest onto that resistance and then a reversal. Okay, so that is a triple top. The triple bottom. It is clearly the opposite of a triple top. Okay, so triple bottom. You're still looking at the triple bottom, and it's the opposite of the triple top pattern. This is how it looks like. Okay, and after the break of the neckline, this confirms the pattern. So we expect a retest like here, okay, and then a clear uptrend. So we said you can enter from here, or you can enter at the retest. Okay, that is triple top, as simple as that. So we have what we call the rounding top and the rounding bottom. Okay, so the rounding top right here occurs in an uptrend, and then the rounding bottom here occurs in downtrend. So a rounding top pattern is a bearish reversal pattern, and it occurs on a clear uptrend. Then a rounding bottom pattern is a bullish reversal pattern, and it occurs on a clear downtrend. So we are saying that, for example, here you will see the price is in a clear uptrend, and then it forms this something of a format like that. Okay, so after forming that, it tends to create this retest, and then it finally breaks into a downtrend. And the opposite is true. So in most cases, you get a downtrend. After getting this rounding part, you do not form this thing of cup and handle. It just forms something like a retest and then it reverses upwards. So these patterns also exist. We shall be looking at them later. So this is how they look like in candle charts. Okay, candles form this round thing. Okay, so this becomes the neckline, and the break of the neckline confirms the pattern, and it is where we enter from. Okay, sometimes it will trend to form a retest, then break down. Okay? That's a rounding top. So we're looking at the rounding top still. So we're saying that it's a bearish reversal pattern, while in an uptrend the price fails to break the fails to keep moving higher and stores around the highest highs, then retraces by making consecutive lower highs, signaling that trend is weakness. So price also makes consecutive lower lows and price starts to move lower, visually creating a rounded top, showing the price reversal. So the pattern completes once the price breaks its neckline. For example, right here, this is a neckline. When it is broken, this is the entry point, and then we catch the wave down. And this is how it looked like, the rounded top. Okay. So that's the rounding bottom. I think everyone can see it clearly. So the price was in a clear downtrend, then it created this rounding form. And then after the break of this neckline, we would have entered from here and then catch the wave. That's the rounding bottom, opposite of the rounding top. Okay. So that's how the rounding bottom looks like in a candle chart scale. So this rounding bottom, okay, I want you to look at it so that you don't get tired. This is a rounding. This is a reversal signal, one uptrend. So the rounding bottom pattern is a bullish reversal pattern and is opposite to the rounding top pattern. It is traded once a neckline is broken and the stop is placed at the lowest low of the curve. So we are saying that if you put your entry level here, this is where your stop loss is going to be at the swing low or the lowest low of the curve. Or the take profits can be calculated at reasonable risk reward ratio. Okay, so that is the rounding bottom. So we are going to look at the ascending triangle as our another that pattern. So this is how it looks like. Okay, ascending triangle. Okay, it is a bullish continuation pattern, just like you're seeing. After forming our ascending triangle, the price normally continues into the bullish momentum and it will reverse later. So it is a bullish continuation pattern. That is how it looks like on the screen. Okay, so this is how it looks like. Okay, ascending triangle. So this is a bullish continuation pattern formed by connecting two trend lines. Sorry. So the first is a flat trend line or a horizontal trend line, while the second is an ascending trend line. Okay. So we're saying that the first one right here, okay, everyone is seeing it, is a horizontal trend line, and then the other one is ascending. Ascending means it is moving from in a clear way, like it is moving upwards. Okay, and then the break of this forming this triangle, everyone is seeing that triangle. So the break of this triangle normally provides a retest and then the price will continue into this bullish format. So when you look here, it was created very well. For example, here this is a horizontal line. It can be a horizontal or flat, and then the other one is ascending. Okay, and then this forms the triangle. After it is broken, you get a retest and then a continuation pattern. So the intersection of both these trend lines forms a rising triangle. So this pattern is completed once the price breaks above the triangle. So unless the price breaks out of the triangle, that pattern is not yet formed. So the stop loss can be placed at a previous swing low within the triangle, and the take profit levels can be set with a 1 to 2 risk reward. Okay. So this is the ascending triangle. It is a bullish continuation pattern. I want you to note that. Okay. Do not forget. So we have a descending triangle. Okay. The descending triangle is the opposite of the ascending triangle. So the first one, trend line, is always horizontal. It's a flat line. And then the other one is descending downwards. Okay. So the break of that horizontal line downwards is what confirms the pattern, and then we get a continuation into the bearish trend. So we are saying the descending triangle. Okay, descending triangle pattern is a bearish continuation pattern. Traders expect the prices to continue the trend after brief pause in the movement. This pattern is the opposite of the ascending triangle that one we've seen already. So first one we said is a horizontal line, and then the other line is falling or it is descending. So after it is broken, we normally get a retest, okay, and then the price continues downwards. For example, when you look here, we connected this one to form those 2 points to form this falling trend line, and then you have this base. Okay, after the price breaks, you can enter from there or you wait for this retest. Have you seen the retest? Then the price continues downwards. So that is the descending triangle. We shall see it on live charts, don't worry. Okay. So we have what we call a symmetrical triangle. Symmetrical triangle. So symmetrical triangle. So we have a bullish symmetrical triangle and then a bearish symmetrical triangle. Symmetrical triangle pattern can either be bullish or bearish, depending on the market. In either case, it is normally a continuation pattern, which means that the market will usually continue in the same direction as the overall trend. As overall trend once the pattern is formed. So symmetrical triangle pattern can also be a trend reversal pattern sometimes, okay? So sometimes you will see that after this triangle is formed, the price will reverse or it will continue. But in most cases, it continues, okay? So we are going to start with a bearish symmetrical triangle. So the difference between this triangle is that the first triangle we have seen, the ascending, for example, and descending, is that it is formed with having this horizontal line, okay? This line is horizontal, but here we have two trend lines. They are all falling. One is ascending and the other one is descending. Are you seeing the difference, please? That is beautiful. So one is made with a line which is horizontal, another one is formed with two lines which are all trend lines, which are all falling. Okay. One is descending line, another is an ascending line. So for example, look here, this is a descending line, and this line is ascending. So this is what we call a symmetrical triangle. So if this happened to be a descending triangle, it would have been like that. Okay. But here we cannot connect to this point. Okay. I'm saying that here we cannot connect these points to form a horizontal line. Okay. So the line we form is going to be ascending line. So, and then even when we connect these ones, we are going to form a line which is descending. So where they meet from is normally where we are going to happen to get a break, and then it can continue downwards. So in most cases, you can see that the price breaks and then retests, and then it goes upwards. So that one becomes a reversal from the major trend. Okay. So this is a bearish symmetrical triangle. You can see that the price was in a clear downtrend. So triangles which are symmetrical would normally depend on the trend. So instead it was a clear downtrend, and then after forming this symmetrical triangle, the price pauses, but in its pause it tends to create a slight uptrend which fails, and then after this slight uptrend has failed, the price will continue in its major trend. So that's why the triangle becomes symmetrical. So you can see that right here we got a parabolic drop from the top, and then it tried to reverse to form something like a higher high, higher low pattern, you can see, but it went on fading. And then after it has faded fully, you can see that after connecting these points, we form that symmetrical triangle. So a symmetrical triangle is always between two lines, which one is descending, another one is ascending. And while the ascending and descending triangle, they form whereby one line is horizontal line. Okay. So we continue. So this is how a bullish symmetrical triangle looks like. So for a bullish symmetrical triangle, it normally happens on a clear uptrend. And when the price tries to pause, it tends to form this format, which is looking like lower highs, lower lows, but it fails out, and then after it has fallen, the price breaks out, and then it continues. So if at all the price broke out, and it went backwards, it would have been a reversal. But I said most of the times we shall continue in a major trend. Okay. So symmetrical, whereby you happen to get a reversal. The symmetrical triangle, for example, where you got a reversal. So for example, look here, this was a clear downtrend. Okay, then the market looked a little bit of choppy. So here we have a falling trend line, and then right here we have a rising trend line. So here we expect that the price is going to come and break and then retest and then fall and then continues into its downtrend. But what happens is that the price broke out, it retested the upper trend line, and then it formed a bullish trend. Okay, so we normally put a entry level here. This is where the stop loss would be, and then we target a clear take profit level. Okay, so we are continuing with these chart patterns. Where you feel lost, please comment. I'll be able to explain. Okay, so we have what we call the falling wedge. So the falling wedge is the next pattern, what we call the falling wedge. So look at the falling wedge, it is happening in a downtrend and then it is formed. Here the lines do not connect. These two parallel lines, they never connect. These two trend lines that you do never connect. But in the symmetrical triangles, the lines connected. Okay, that's the basic difference. So let us continue. So when you look at the falling wedge, okay, is a bullish reversal pattern. Okay, the other one was a confirmation pattern. So the pattern consists of two falling trend lines with prices moving within the trend lines. The trend lines converge each other but do not join. Are we together? Trend lines converge each other but do not join to form a triangle at a current market price scenario. Okay, so breakout above the upper falling trend line completes a pattern, and the trend is validated by a close of the candle above a falling trend line. For example, we shall look at it later. So stops can be placed below the previous low with profit targets at 1 to 2, and then we said that stop loss and take profits, we shall be using the ATR indicator. Okay, excuse me. So we are saying that in a falling wedge, we have two falling trend lines. They are converging, some sort of this, but they will never meet. They never meet according to the current price. They never meet at the current price. So for example, if this is where the, okay, if you have something like this, okay, so this is where our current price is. You shall have this trend line which is falling and another trend line which is falling. That forms a wedge. They are converging, they are decreasing in size. For example, from here it could be a little higher compared from there to here, but they never meet at this point. Okay, and the price comes and breaks this upper trend line, it retests it, and then it forms a new uptrend. So that's a falling wedge. Okay, don't get lost, don't get lost, don't get lost. So for example, when look here, we have a clear downtrend, we have this upper trend line, then you have a lower trend line. They are trying to converge, but they never meet at the current market price, and then we get a breakout right here. So our stop loss would be at a recent swing low, then the target profit would be at a reasonable risk to reward ratio. Okay, so a falling wedge occurs in a downtrend and it is a bullish reversal pattern. Okay, the price changes and then gets into a bullish trend. So once again, the basic difference between a falling wedge and a triangle is that we said in a descending triangle, we shall have something like this. And then that something is that here it has a horizontal line. Then we have a symmetrical triangle whereby this downtrend line is not horizontal. Then in a falling wedge, these two trend lines never meet, but they are converging. Okay, those are the basic differences I want you to keep in your mind. You pause the video, take some pictures so that you can be able to read the literature later on, and you have to keep updating yourself. Okay. So we have a rising wedge, which is occurring in an uptrend. Okay, and it is the difference of a falling wedge. We are gonna look at it. So a rising wedge pattern is a bearish reversal pattern. The pattern is formed by two rising trend lines converging in the end but forming a triangle. Sorry, but not forming a triangle. So the entry is confirmed once the price breaks below the rising trend line with the stop being above the previous high. Then profits can be booked with a good risk reward ratio. So we are saying that in a rising wedge, we form two rising trend lines which have not converged at the current market price. That is what you know. They have not okay, they converge, but they do not meet. sorry, they converge, but they do not meet at the current market price. So this is where the current market price was. So after the break below this lower trend line, confirms the pattern, and then you enter your short trade. Okay, so that's a fall. So that is a raising wedge, and it is a bearish reversal pattern that the price is in an uptrend, and after forming that raising wedge, the price breaks, retest, and then it falls downward. So sometimes it retests, sometimes it does not retest. Like it didn't retest, just continued. So we have the rising peanut. This one we have a rising peanut. We have a rising peanut. So everyone, I want you to look at it and then you memorize it very well. So this one occurs in rising peanut occurs in an uptrend, and it is a continuation pattern. Okay, for an uptrend. So rising peanut, okay, looks like, so it has a flag. It looks like a flag like this, and then the price tries to drop. It goes to drop and then breaks the upper line and then continues. So peanuts are continuation patterns depending on the formation within the trend, and they can be classified as bullish or bearish. So the pattern is formed when prices while in an uptrend stay in trend lines and show consolidation due to traders partial profit booking, and then the consolidation phase is marked by the price staying within trend lines forming a triangle. Okay, so we are saying that on a clear uptrend, the price tends to consolidate. Okay, and then after this price is consolidating, but I want you to note that when the price is in a clear uptrend, the consolidation tends to be like it is falling, but this consolidation will fail. Okay, after it has failed, it is broken, and then the price continues. Okay, once again, it is in a clear uptrend. Okay, what for the clear uptrend, the price tends to fail, but it looks like it is falling to create a new downtrend. And then when you connect these points, you get some sort of a triangle, which is later on broken and then retested, and the price continues. That is what we call a rising peanut. Okay, that's what calls a rising peanut. And these things normally happen when the trend is so parabolic. Okay, when a trend is moving at a 90-degree format or something like that. So trends which are moving at this level, they normally tend to do this. Okay, and then after this is formed, the price breaks and then it continues. That's what we call rising peanut. So when the trend is at around 45 degrees or 30 degrees, it tends to be more stable, and it is normally very difficult to form peanuts. Okay, you'll be seeing this with time as experience grows. So we have what we call a falling peanut. Falling peanut occurs in a downtrend, okay, and it is a bullish and it is a bearish continuation pattern. So in most cases, the price will be falling parabolically. Then the price tends to be like it is increasing in a consolidation, but it fails to increase and then fails to finally breaks this level, right? Like here, this trend line. So we are saying that when the price is dropping in an uptrend, when it consolidates, for example, here, it tends to be like it is forming a new uptrend. But this uptrend is failed by the break below this small trend line which is formed. Sometimes it is retested and then the price continues downwards. That confirms a falling peanut. Okay, I want you to note those things clearly. So we are looking at a falling peanut. Okay, I said that the price in most cases will be falling parabolically, like you're seeing here. And then when it tends to consolidate, it tends to consolidate in a way that it is as if forming a new uptrend, but it fails. And then it breaks the lower trend line, retests it, and then it continues. So falling peanut is a bearish continuation pattern formed during a downtrend. So the price should be in a downtrend. That's number one thing to note. And the pattern has to be confirmed within the downtrend. So the consolidation phase, once broken, will lead to continuation of the current trend. Okay. So for example, in look here, so a clear uptrend. After the price falls parabolically, we can see that the price looked like it wants to create a new downtrend. But this downtrend was not confirmed because this swing high here was supposed to have come in this format. Okay, this higher high, higher low. But what happened is that the price went high, broke down, it created a new high, but this new high was not higher than this. This is not a higher high. It is a higher low in most cases. And then it drops, then these highs tend on to decrease. After they decrease, you tend to form this upper trend line, and then this lower trend line is also formed. So when the price breaks the lower trend line, it retests and then it breaks. Okay, that forms a falling peanut. It occurs in a downtrend. No downtrend, no falling peanut. Okay, so we have what we call flags. Okay, and flags can be bullish or they can be bearish. Okay, so a bullish flag pattern is a piece of price action that occurs in a candle chart after a major upward move. So in a bullish flag pattern, the market consolidates between two parallel lines of support and resistance before eventually breaking through the resistance and resuming the original uptrend. So this is a bullish continuation pattern, or okay, it is a continuation pattern in short. So the support and resistance lines form the flag from which the pattern gets its name, and the preceding upward move is the pole, and often price the market price will move downwards within the flag. Okay, so a bullish flag creates a pause in the original uptrend, but not strong enough to create a reversal. Instead, the price remains flat and moves slowly downwards as the bulls ensure that the market does not fall too much. This is the same thing that has happened in triangles and peanuts. We said that if you have an uptrend, when the price consolidates, it has to consolidate in the opposite of the trend, but it fails to break the trend and then it continues. Okay, are we clear? For example, even a clear uptrend, okay, when the price tends to consolidate, it normally consolidates forming some sort of a bear trend, which is very short, but it fails and then it continues. This is something you're seeing in the image right here. So here the price was moving high, okay? So when it consolidates between the resistance and support level, it consolidates forming a downtrend. This is now a downtrend. It looks like a downtrend, but this downtrend is failed after the break through the upper resistance line. The upper resistance line then becomes a support, and then this support level supports the price to move high again, hence becoming a continuation pattern. Okay, so that is a bullish flag. Okay, this swing becomes the pole of the flag, and then the consolidation is what forms the flag. Okay, this sort of thing. It has an upper resistance and then a lower support level. So the resistance is broken, and then it becomes a support, and then the price moves high once again. That forms what we call the bullish flag, or and this is a bullish continuation pattern. It occurs in an uptrend. Okay, that's the first thing to note. For example, here you have an uptrend, the price is falling, forming some sort of a bear trend, which fails, and then the price breaks through it. It tends to retest, but this time it did retest, and then it continues. So in most cases, you get retests, sometimes you do not get it. That's why we normally place the stop loss below the swing loss, so that when the price comes to retest, it does not hit you out. So price moves high, creates a consolidation, breaks the consolidation. After breaking a consolidation and you enter from here, you normally put your swing low here, because we expect normally a retest onto the broken resistance, so that this retest does not stop you out. That's why you put our stop losses down below the swing lows. Okay, so we are continuing. Here we have a bearish flag. Okay, so a bearish flag pattern is a piece of price action that occurs on a candle chart and occurs in a major down move. So in bearish flag pattern, the market consolidates between two parallel lines and resistance before eventually breaking through the support and resuming the original downtrend. So the support and resistance lines from the flag form the flag, and the pattern gets its name. So the preceding downward move is the pole, and then the market price moves upwards in the flag. So the bear flags, they create a pause in the original downtrend, but are not strong enough to create a reversal. Instead, the price remains flat or moves slowly as bears ensure that the price does not rise too much. Okay, so we are saying that the price is in a downtrend. It creates a consolidation, but this consolidation is in the opposite of the current market trend. Are we together? Price drops, creates a consolidation which is in opposite of the current trend. For example, it creates a consolidation in an uptrend, in form of an uptrend, but it breaks it and then it continues downwards. That is what confirms a bearish flag. So a bearish flag occurs in a downtrend, and then it is a continuation pattern so that the price continues in the bear market. So for example, here it's a clear uptrend, price falls parabolically, it forms a flag. This flag seemed like the price is going to create a new uptrend. And we see that after it is broken, it tends to retest and then it breaks downwards. Okay. So simple as that. That is what we call a bearish flag. So we are continuing. We have what we call the rectangles as chart patterns. So a rectangle is a chart pattern formed when the price is bounded by parallel support and resistance levels. So rectangle exhibits a period of consolidation or indecision between buyers and sellers, but neither has a dominant or has a dominancy. So the price will test the support and resistance levels several times before eventually breaking out. So from there, the price could trend in the direction of the breakout, whether it is the upside or downside. Wow. So a bearish triangle is formed when the price consolidates from a while during a downtrend, and then a bullish triangle forms when the price consolidates for a while during an uptrend. So we are saying that if the price is moving high and then it forms these successive levels of support and resistance, but they're supposed to be parallel. If they are not parallel, please, this is not a rectangle. Okay. And then after that, price can break and continue in that current market trend. Okay. And then if the triangle occurs in an uptrend, it becomes a bullish triangle. And then if the price, if the triangle occurs in a bearish trend, is normally what we call the bearish triangle. So if it is in a downtrend, some sort of this price consolidates, form here a resistance and a support. The support is broken, retested, and the price goes down. Okay. So we are continuing. So this is how a bullish triangle looks like. The price was in a clear uptrend, and after that it consolidates between these two parallel lines. It breaks, it may retest, and then continue. So if you enter from here, you have to make sure that your stop loss is below the triangle so that a retest does not get you, because sometimes you can get this is support level which has been broken like this, then price drops and enters into the triangle and then it continues. So if you had put your stop loss below the support, sorry, before the resistance, below the resistance, you would have get stopped out, and then you say that the broker is bad. So here we have a bearish triangle, price is in a downtrend, then it forms two parallel lines of resistance and then support. If the price breaks the support, retests. This is what I'm talking about now. So in most cases, when you look here the price broke. So if this was your entry level and then you put your stop loss right here, so this swing low, sorry, this pullback, which confirms the retest, normal cases will put you out. So that's why I'm saying that when you enter from here, okay, make sure that your stop loss is above the triangle so that this retest will not get you. Okay, as simple as that. So you make sure that your stop loss is wide enough, because this is price drops, creates a retest. So when you put your stop loss above this level which has been broken, this level here which is a support, if you put a stop loss around here, this retest is going to put you out. Okay, but you have to put your stop loss above the triangle so that when the price retests, it does not get you, but it will continue in the direction of your trade. Okay, simple as that. That's a bearish triangle. So we are going to look at the cup and handle. Okay, the cup and handle. This is a bullish reversal pattern that occurs after a long downtrend. Okay, so a cup and handle price pattern resembles a cup with a handle, where the cup is the shape of U and the handle is a slight downward drift. So the cup and handle is considered a bullish signal, with the right hand side of the pattern typically experiencing lower trading volume. So generally cups with longer than more, sorry, generally cups with longer and more U-shaped bottoms provide stronger signals. So avoid cups with V bottoms. For example, you're saying that we are saying that when you get a cup which is having something like this wider, this one tends to form a more strong signal compared to a price which is like this. So this signal is stronger than this signal. And then you have to avoid something like this. This is not a cup and handle. Okay? That is a V. So ideally, the cup should not be overly deep. Avoid handles that are overly deep also, as handles should form in the top half of the cup pattern. Okay? So this is how the cup and handle looks like. Okay? You get price moving in this form, like the rounded bottom. But in this format here, when you get a rounded bottom, it moves like that. The price continues upwards. But in a cup and handle, you get this round bottom, and then you get a handle, okay, and then the price continues upward. That's the best difference. So for example, when you look here, and then this handle is normally normally the opposite of this trade which is trying to form. So in most cases, people see the cup and handle as a flag. Huh? This type of flag. They normally see it in this format, but this is not true. This becomes cup and handle because of this previous round bottom. Okay, and when the price breaks this handle, we normally get our confirmation after the break of the neckline. The neckline is the mouth of the cup. So for example, look here. Okay, this is now rounding bottom. So this could have looked like a cup handle. So this would have been the entry. Okay, so here you formed it. Okay, you get your handle. So this is the entry. Okay, as simple as that. So that's a cup and handle. So when you look here, this is a cup and handle pattern. You get this rounding bottom. After getting this rounding bottom, you get this neckline. That's the mouth of the cup, and that is the entry. The entry is after the price has broken this level. If the price does not just break this level, please do not enter. If the price does not break this level, please do not enter. Okay, so this handle is normally in the opposite of this this trend which is trying to form. Okay, so we are going to check out the most profitable forex patterns so far. This is somehow true or somehow not true. So we have the double tops, and then the double bottoms of the head and shoulder, rounded top, rounded bottoms, triangles, peanuts, and a few profitable bottoms to name. Okay, so however, most patterns can be traded profitably and would provide high risk and reward ratio. So it is best to prepare a summary of all patterns and keep it handy to assist while trading. So a comprehensive PDF of the patterns can be downloaded here on this video, but I would love to, if you need it, if you need a comprehensive guide of the PDF, okay, please you simply comment, okay, and then I'll be able to send it to you, or you can divide ways and send you a picture, or you can download from Google a picture of the profitable chart patterns, those we have covered in this video, and then we can be seeing how to move on. Okay, so right now I want us to move on to a live chart and then be able to see how we can spot these patterns, because what we are seeing in literature in the video is far different from what you're going to see on charts. So things in the video here have been looking so clear because I've been explaining to them, but when you look on the live chart, it might simply become a little harder for you to spot these patterns. So for example, the double bottom, so sorry, those ones are easy, but for example, the head and shoulder patterns, they might look a little hard to get. Okay, so let's get onto live chart and see. Well, we are onto a live chart and we want to be spotting some examples of the chart patterns we have been looking at, and this is Euro USD. And in most cases, patterns, they are stronger when they are formed on a higher time frame. So if you get a reversal pattern in a monthly time frame, this is stronger than a reversal pattern within the minute time frame. So the higher the time frame, the better. So patterns, they work hand in hand with the time frame. So a pattern is more reliable when it is formed in a time frame which is higher. The daily time frame, weekly time frames, monthly time frames, and then the yearly time frames. Okay. So on this chart, we are going to be getting back into history so that we can be able to spot the patterns. So for example, when you look on the chart right on your screen, okay, you can see that here it tried to look like this is a double bottom. Okay, this looked like a double bottom. And the question is it a double bottom or it is not a double bottom? Okay, so when you turn on a line chart and you exclude those market reflexes, for example here, you can see that this looks to be a what? This looks to be uh, a double bottom. Sorry, yes, a double bottom. And then this looks to be its neckline right here. And after this neckline has been broken, there seemed to be some sort of a retest here, but it was not perfect. Okay, so this looks to be like a double bottom. Okay, and we said that this double bottom in most cases look like W. Doesn't this look like W? So you see that things on a chart look different. Okay, so someone can confirm to you to this as a double bottom. You see, instead of you getting something so clear like this, and then you get something like this. This is also a double bottom, and this is a double bottom. Get the point? So let's get into history and see how this goes. So we turn on our candle chart. Okay, we shall be able to spot some chart patterns. So for example, when you look here, we see an example of a chart pattern. So for example, here we're trying to see, this is our leg. This could be like head and shoulder pattern, something like that. Doesn't this look like a head and shoulder according to you? So what we're going to do is that we shall turn on our line chart and see if it is true or it is not true. Okay, turn on a line chart like that. Does it look like a head and shoulder? Okay, this could be a left shoulder, this could be the head, this could be the shoulder, and then this could be the neckline. And after it is broken and then retested, what happened? The price reversed. You see, this is how things look like. When you come to the live chart, things get more complicated. Okay, so go back to your chart here. So this looked like it was forming a head and shoulder, and then this could have been our neckline here. Not so perfect, but it was cool, and it is a clear head and shoulder pattern. Everyone can see it. It is preceding an uptrend, okay, and then it forms this left shoulder, forms the level of resistance, head, then shoulder, then this, okay. After the neckline is broken here, we had to put a limit order here, and then the price retested. So if it retests, you get also put an order there, and then the price try to reverse. So if you move this to minute 15, you would be able to see this very clearly than on this H4 time frame. So when you get such a pattern in a higher time frame, and then you move on a lower time frame, it tends to look more clear. Okay. So we go backward, 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 backward. So what happened here? Do we see any form of a pattern? So for example, you have to go to a line chart maybe. But because now, when you look at this line chart, it will tell you that this is a shoulder, and then this is a shoulder, and then this is the neckline. Doesn't that now connect and then becomes an inverted head and shoulder, something like this? And then this becoming your neckline, and then the price reversed. Are we seeing this? This pattern? Are we seeing that? Then the price moves high, this becoming our neckline. But when you tune on your chart, okay, you cannot be able to spot this. And there's no head and shoulder here. The same thing happens here. We see something like this and something like this connecting. Does it look so? Let us turn on a chart. Sorry. Let us turn onto line chart and see if we can get a head and shoulder pattern. Then when you look here, it is not seen at all. You have this one looking like a shoulder, then this, and then this looks to be a neckline. And then this looks to be the retests. Okay. So when you look here, we have our double bottom clearly seen. And this is the neckline of the double bottom. Then the price breaks and then forms that. Then when you look here, forms a double top. And this is the neckline. And then the price move downwards. So those are chart patterns. So if you thought things are so cool and so easy to spot when you come onto live chat, please, that was a misguided hope. So, but when you turn on the chart, can we be able to spot what we have been spotting? So we can look here and see that here form some sort of a shoulder, some short of a shoulder, some short of a retest, and then the price reverses, and this just looks to be the head. Okay, and then this looks to be the neckline right there, the head and shoulder. Okay, but when you come here, you can say this was a double bottom formed once again. This was a clear double bottom, and this becoming the neckline. This is the retest, and that's the entry point, and then you collect profits. Okay, so we tend to get into the history more again. Then we see if we can spot some more patterns. Does this look like a head and shoulder? Let's see and see. So do we see a head and shoulder pattern right here? Do we see some sort of this drop, increase, drop, increase, okay, then drop. So after here, this is a neckline. Then after this, like this candle break, don't you think you get an entry signal? It is not so clear, but this is for the experienced people only. Here, don't we see a double bottom, this, and then this? So price drops, it increases, then it drops, then it increases, and this is the neckline. This is a clear double bottom. How many could spot that? So if you're a beginner, you will not be able to spot these things. But when you look at the chart, this is the first drop, creating the first swing low, the second swing low, and this is the neckline now. Okay, so the price dropped, went back, then it dropped, and then it went back to break this neckline. After the pattern has been broken, it creates the double bottom. And then after this retest, we get this candle pattern. This is a reversal pattern. That's a hammer, inverted hammer. Okay, and then the price increases. Okay, okay. Head back into history again. History, 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 history. Bam, bam. Can someone see a double bottom again? So you can see this one, and then this one, and then this neckline. Can someone say that? So here the price drops, increases, drops, increases. After the price breaks this neckline, like right here, we are waiting for a retest. Okay? If you do not wait for a retest, make sure that if you enter from here, this is the break of the neckline. Okay? If you enter from here, you make sure that your stop loss is far here. Okay? So that when the price tends to create this retest, it does not move you out. Because that's how the market is psychologically. It has to create something of a sort. And then the price, you create those profits. So if you say that the price from here, if this is like 10 pips, I'm just giving an example, this would make something more than 10. Okay? And that's how trading goes with these patterns. So they are confirmed with other things like candle chart, like candlestick patterns. For example, when you look here, and someone see a hammer, like I'm seeing, it's beautiful. So history once again. And we see something like a rounding bottom or a rounding something like that. No, we are going to see a double bottom. We are saying that this trade came like this, and then like this, then like this. That is a double bottom. Okay, so someone else could see a triple bottom in this format of this, 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 and then this. So someone can see a triple bottom again, but a double bottom looked more better because of this, in the market reflex. Okay, and this is the neckline. So as you see here, we didn't get that so much of a perfect retest here, but if you entered from here, put a stop loss here, you would have gotten the wave up. Okay. Still, we are going back into history. We've seen this part. History. We are looking for chart patterns so that we can be able to memorize them. This one would have formed something like a cup and handle pattern, but here it was so parabolic. Yeah, would have formed like a cup and handle. Someone see it. This being the neckline. We always told you that there is going to be a retest after the break of this handle, retest, and then the price increases. So when you look at this, if you're a beginner, you will not be able to spot it. This, okay, then this, then the price breaks this one, it comes back to retest it, retest the neckline here, and then after retesting it, increases. So we shall be seeing this as more of practice when we make live streams of market analysis every week. So do not worry about these patterns, okay? So, and I want you to record that for every time you get major trend in most cases. So now, for example, when you look here, this one would have looked like some sort of a triangle thing or some sort of peanut. So when you look here, you have a clear downtrend, and when you look here, you can connect these lines to form a lower trend line, and then when you join these upper ones, you can tend to form some sort of this. Okay, and we see that, and then the price broke through this consolidation, irrespective of this market reflex. So if you ignore that reflex, you would be able to get some sort of this, and then you continue. Okay, or in most cases, this would have gotten us a bearish triangle. Okay, some sort of this triangle, some sort of this. You ignore the market reflex. So now this comes to the experienced people. So no one would, as a beginner, would be able to spot that this could have looked like a triangle, this, okay, because of this market reflex. But if you could be able to ignore that market reflex, this is a clear triangle. And then we are expecting that when the price breaks through, we are going to continue downwards, and we did. Okay. So when you come onto a live chart, things are not going to look exactly the way you want them to look. But this is a clear format of a triangle, but it has this market reflex, which you are supposed to ignore. And when you go back to the video of support and resistance, we say that in most cases, if it's a support level, when the price hits it like this, it can tend to break it and fails, and then it hits it, and then it drops backwards. So we tend to ignore these market reflexes. Okay. So we get another chart pattern. Let's try to work around and see if we can get one. So, and we tend to form some form of this, depending on how the market was currently. Can someone see this? And when you're doing these things, please do not force them, okay? Don't force them to happen. If it does not happen, please let it be. Can someone see this? This is a symmetrical triangle. Can someone see this? And then after it was broken, okay, it was retested, and then the price reversed backwards. Okay, so this is gonna happen all the time. So with practice, we shall be able to spot them very well. Okay, so with practice, we shall be able to spot them. Nothing to worry about. Okay, so it's a rounding bottom, whether you agree or not, and don't expect it to be so clear. This is a rounding bottom. So it tends to come and retest, and the retest was so big, so it was unsuccessful. Rounding bottom. Okay. So you're looking for other chart patterns. This is the double top. And someone say this top A. Someone see top B, someone see the neckline, and then after break retest, price moves downwards. Someone see that? I'm leaving the chart on the screen so that you can be able to see it clearly. So this is the first top, okay? This is the second top. This is our neckline. After the price has broken the structure, it tends to retest and then reverses. So I'm not telling that you go out and then start trading these things. So with time, we are going to be practicing together through like every time over weekend. Shall be making a video for market analysis, and then we see where the market is going to be in the next week, and then we shall be able to create a trading community where we shall be following up each other. So this is now a rounding bottom, whether you want or not. It will not be perfect like you want it, but it's a rounding bottom. Okay, and then this would have been its neckline right here, and this is a retest. So in most cases, you have to see these patterns in form of a future plan. So my entry as a person would have been around here, depending on other formats of entry that I use as a person. So we shall be looking at them also later on. So we are looking for more patterns. I'm trying to see if we can spot a very clear head and shoulder pattern, because it's one of the most common patterns in Forex trading. But so far not gotten one yet. So this is a double bottom, and majority of people cannot see that this is the first bottom, this is the second bottom, and then this is the neckline. So whether you agree or not, this is the format of the market. It will not give you things which are perfect. It will not give you something like this. But in most cases, it's going to give you this. It is going to give you this. And this is going to be your neckline. Okay? Some sort of this. This is a double bottom. Look, go high, look. Because in most cases, you expect over market. We say the market moves in this format. Okay, so what we expected right here was that the market has formed that issue of this, 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 and then after this retracement, we expect to drop more and then continue the format. But when it reached here, it broke the structure. It reached here, raises. We expected to break down, but it ended in the middle and created a new bottom, and then it reversed, breaking this level also. So when you look clearly, here it tends to create a reversal, but it failed to create a perfect what? A perfect retest. So in most cases, when you have your double bottom like this, and then the retest comes, it might not reach your neckline. It's not a must for it to reach, because it's market psychology. Traders are greedy, and that's why even their trend was not so much successful. Then here you get this candle which involved news. Okay, after it was in the clear down uptrend, you got news, and then the market reversed. Okay, so we're still looking to see if we can spot more patterns. And someone see a triple top, and someone see a triple top bottom. Sorry, a triple top pattern. You have this, and you have this, and this is your neckline. So here you get a retest. So we expect the market to reverse downwards, and it did, though it had to come and hit our stop loss first. So that's a problem. So we are winding up this video very soon. Okay, so this is a double bottom. I think everyone can be able to spot it. This is a bottom one, and this is bottom two. And then we say that the market will not always give you this perfect, but it will give you some sort of this or some sort of this. Okay. And now this was the neckline, and this was the retest after the break. And someone see that pattern right there? Here, 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 here. After this is the retest. Then the price goes up. Okay, so how do I spot this before it is formed? That's one of the questions I know. So but it will be seen later on, so that when you look right here, that we expect that this is. So for example, here the market had not yet formed. So when you look, we have this, then we have this. So we are expecting the market to come and to not hit this level, but when it comes and breaks that level, then it becomes, it's now there we create a double bottom because this neckline is broken. So if this neckline was not broken, then we wouldn't have expected it to be a double bottom. But because a neckline is broken, it completes the structure as double bottom. Okay. So we move backwards to see if we can spot any other structure. Can someone see head and shoulder pattern right here? I bet for beginners you will not see it. But here you have a shoulder, here you have a head, here you have a shoulder, then right here you have a neckline, right here. So I know someone saying it's not clear, but it is fine. It is your argument, but that's how the market gives you the head and shoulder pattern, not how the books give it to you. So you have to trade what what the market gives you. So that is the head and shoulder that you have right there, and this is the break, and then this seems to be the retest of the market. So that is by experience that you have to be able to spot this. And then this one was also another retest if you're waiting for a bigger retest. Okay. But that's how the head and shoulder pattern looks. It will not give you something so clear like this, and then you have a horizontal neckline. But the market is going to give you this. The market is going to give you that. And then maybe in double bottoms, it's going to give you something like that. Instead of it coming to give you something like this, so perfect. It will not happen so easily. Okay. So here is a double bottom, whether you agree or not, of this. So we are not seeing so much of peanuts, so much of flags. So much of flags are not happening so much, okay? But they also do happen in the market. Is someone seeing an inverted head and shoulder, though it was not successful? This is a shoulder, this is a head, and this is a shoulder, this is a neckline. Okay? Yeah. So that's why in most cases we tell you to wait for retests. And then the other thing is that every time you spot a pattern, it will not work the way you want it to happen. Okay. Not that every head and shoulder pattern you get, it will be a successful one. So the market can change its direction because of so many different things. But this is what it was forming. Isn't that a head and shoulder pattern? Okay. So that's how the market forms its swings. But when you bring a beginner, you cannot be able to spot this. So, and you cannot be able to think of drawing your neckline in some sort of this format. You will not be able to say, let me join this, don't form that one as a neckline. And after the market has broken the structure right here, you expect a retest and then continuation. Okay. So that was not successful. We are continuing to see if we can get some other patterns. So here it looked like it is creating double bottoms right here. And then this looks to be the neckline. Okay. This is the retest, and then the market continues in our direction. Okay. So it was a little bit more volatile. Which one haven't we seen? We have not seen wedges, but I want you to note something of a pattern like this one. This pattern. Someone seeing this? Who remembers that pattern? Isn't this a bearish flag? And this is the breakout candle right here. This is our entry. Catch the wave down. Okay. And this was the downtrend which was coming, forming a flag. This is the format we are looking at. Have someone seen it here? Then you get this slight consolidation, which is in the opposite of the market direction, and then a drop backwards. Okay. Still looking around to see. It's a double bottom. Okay, yeah, there is a double bottom. We have this. This is a double bottom. They want or not. So we can try to go into the Or we can use another chart, for example, gold. This way you can get gold and see gold, dollar. I need a default chart where we can see clear things. So here you can see a double bottom. These are triple bottoms, sorry, on gold. Those are 3 successive bottoms. And then this is the neckline, not this level here up. Or probably if you've been able to spot a double bottom, this could have been your neckline. Okay. If you spotted a triple bottom, you would have excluded this and take it as a market reflex. Okay, because this is the idea. So it creates bottom 1, bottom 2, and then bottom 3, but you have to ignore this as a market reflex. Okay, so that is on gold now. So far we've seen one pattern. We want to see if we can spot any other pattern. Okay, and then we can also clearly see that the market moves in this format. 1, okay, then 2, then 3, then 4, 5, and 6. So we expected the market to break this level. We expect the market to form this level, but after it has failed to break that level, we get the bottom. So we say, oh, we are going to form a double bottom. The market tries to form this, then it comes back. Oh, we say it has formed what? A clear double bottom. And then there you get your entry. So here it tried to form a head and shoulder pattern. Yeah, but we did not get it so clearly. Okay. Then the retest and then the break backwards. Okay. So if you want to draw trend lines, of course, you'll join this point, then join that point, then this one. So when you get a trend line break, for those ones who want to trade with trend lines, you see, it's become so beautiful and so clear. So after this trend line break, you would get your entry around here if you do not wait for a retest. But if you wait for a retest, of course, you will not enter from there. You will wait for a retest to come. But it is also similar to someone who has seen that this is a double bottom, or someone who has seen that this is a triple bottom. It's also some of the person who has seen a trend line. Okay, they're all chart patterns. You can use them. Again, we have a clear double bottom on this gold. The gold pair on a daily time frame. And we say that every time a chart pattern forms on a daily time frame, it becomes more stronger. Okay, so here you have successive bottom 1, this is a bottom 2, and then here you have a retest. Okay, and then you got your trade successful. Okay, so we want to go back in history and see if we can spot this looked like an inverted head and shoulder, but it is not an inverted head and shoulder. So for example, look here. This is not inverted head and shoulder because the preceding trend was not a downtrend, okay? And then this looked to be the neckline. But I did not buy that idea because the preceding trend in inverted head and shoulder is supposed to be downtrend. Then you get some sort of this. But here we are having this, then we have this, and we have this. This is not an inverted head and shoulder anymore. Okay, we can continue a little bit. You see the preceding trade was an uptrend. So that was just market reflex. Bam, 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 bam. So you can see here that you got a double bottom. So double bottoms are so profitable and this looked like a triple bottom, okay? The market tried to reverse. Here, got this level of support of that neckline and then can be able to form triple bottom. Okay? So I think we can conclude the video from here. I don't know if people need more experience on this. So here, when you look here, the market created this new swing low, but it failed to break. Then tried to create some little bit of double bottom. Double bottoms are so common. Triple bottoms, very rare. Head and shoulder, a little bit common. Flag spinners, they're a little bit common. So for example, here you have a flag, but beginner would not be able to see that here you have a bearish flag. Okay. And then have that. And then the price continued. Can someone see that as a flag? Thank you so much. So beginner level, you have to be patient with these things, okay? So yep. Here you can see that we have a cup and handle pattern. I don't know if majority can see it, but it worked out to be a little bit profitable. So here, and then we said you have to avoid caps which are having V shape, because now after this V shape, the trade was also successful. But if you move to a lower time frame, of course you would have gotten something. Okay. Okay. We are trying to look for more patterns and see. There's a clear cup and handle. We've seen it. Okay. So even here, it looked like it is forming a cup and handle, but it was not on a downtrend. This was an uptrend. So this is not a cup and handle because the preceding trend is an uptrend. Okay. So you have to avoid such. So those human errors. Okay. That's a double bottom. Everyone can see it. Okay. The rounding bottom, some sort of. Okay. So I think we're gonna end the video from here. Okay. So if there is anything that has not been so clear to you, you have to make sure that you send me a comment so that I can be able to make stuff clear for you. So here we can have some sort of this, then this, then this a peanut. So you have some sort of a peanut right there. And after the breakout candle happens, you got some bits up, though this big retracement backwards would have stopped you out at a break-even point. Okay. What else can we see in this market? So I want to make some things look a little clear. So for example here, but though according to our way of trading, this sort of a thing wouldn't have gotten you. So this raising wedge, and someone see this raising wedge. Okay. Someone see that raising wedge. So there you have a triple bottom in a greater view. You've zoomed in the market, you would be able to see that right on this level you have a clear level of resistance, and then it has been tested 1, 2, 3, and then 4 times, and then after the break of the neckline of the resistance, we're able to get a wave down. Okay, so here we said you have a flag, here's a bear flag, and then it falls downwards. Okay, so I would like to end this video right here. Those on YouTube. So for example, here you have a raising wedge, but a beginner wouldn't have noticed some sort of this. Would someone see that? And this is a breakout candle, and then this is market reflex. Avoid it. What else can we see in the market? What else can we see in the market? So forecasting and then looking at the market at the current type is in most cases difficult. Look at the market at the current situation where it is. Okay, so you have to expect that. So when you go to a higher time frame, you'll be able to get more stable patterns. That is in conclusion. And then you have to always wait for the patterns to break the structure so that you can be able to use them. And then the other thing is that patterns always happen either in a bear market or in an uptrend, and then you do not force things to happen. So for example, what we are saying is that, for example, you cannot come and say that at this trend line, come and join all these points like this. Okay, yes, this one is perfect, but let me say right here, you cannot join this lower bottom to that one to create a trend line. But if you looked at it in a greater view, it would have been some sort of this. Okay, So you shouldn't have drawn something like this, because now the trend line is no longer respected. Okay, so you do not cause things to happen. For example, connect these 3 points. Yes, for these ones connect, but if you connect it to here, you leave out 2 major points. Okay, do not force things happen. Okay, so one thing I want you to note when you're drawing these patterns. For example, when you look here, it looks like it is forming a head and shoulder. This is the head, this is another shoulder, but where is the shoulder this side? It does not appear. So don't force this one to look like it is a head and shoulder pattern. Okay, so thank you for watching this video. I would love to end the video right here. My name is Susom Jordan. In case you've not understood anything about these chart patterns, please comment in the video, and then I'll be able to send you a PDF where you can understand that pattern you've not understood so well, so clearly. Okay, so thank you for watching the video. My name is Susom Jordan, but before I close the video, I want to end with this pattern here. So we looked at that one. So that is a descending triangle, and I wish everyone could be able to say that. So this descending triangle marks the end of this video. Thank you for watching this video. My name is Tom Jordan. I'll see you next video. Please comment for anything the way you've not understood. Thank you. Subscribe to the channel, share, and give me more likes. Thank you. Bye bye.